Let's talk next about IBC or privatized banking's account structure. So how do we build these accounts? How should they be built? Now, as a caveat or word of warning on the front side of this, as you've heard me teach and train before, this should only be involving a dividend-paying, participating whole life insurance product, okay? Not an indexed universal life, not an equity indexed universal life, not a guaranteed universal life or a standard universal life. Nothing, if you hear the word universal life, run when it comes to IBC. They should not be using that for a banking system, okay? So with that aside, so we can focus now on, we're talking about a dividend-paying, participating whole life insurance product. So the first thing you have to do is you got to determine two things capitalization-wise or funding-wise. The first thing you have to determine is how much do you want to put in up front, if any. I've had clients put $1,000 in, or clients put $1 million in. Completely up to you. You can push whatever you want to from the public banking arena into the private banking arena. As long as it doesn't violate any thresholds or whatever, then you can do so. Okay, so how much upfront money do you want to put in there? And by the way, as a side note, if you're going to purchase a vehicle, or you're going to purchase a home, or you're going to purchase an investment property, you're going to go on a vacation, or pay for a wedding or for a funeral, or do home improvements, buy precious metals or some other type of investment, or if any of those cash outlays are anticipated, then you may want to plan for that by front loading the account, dumping that amount of money in up front, so you can then turn around and process a policy loan, capture that so you won't have any lost opportunity cost or interest charges. You can capture that money. Everything that goes in these accounts is captured, okay? So you got to determine what you want up front to put in this account. Secondly, and again, that can be zero if you choose. And secondly, what do you want your monthly premiums, or it could be annual premiums? What do you want your capital outlay or your premium structure to be? Now, one of the things that Nelson really drove into our heads was, don't be afraid to capitalize this account. Everything you put in this account, if you do it properly, you're going to get every penny back plus interest. So there's no reason for any kind of reluctance as far as what you do to capitalize one of these accounts. Now, the goal that we have up front when we set these up is that 95% of or 95% of any upfront money be available immediately the next day, and 50 to 80% of the monthly premium, or B, be available the next day. Okay, so we want 95% of all upfront monies, 50 to 80% of all monthly or ongoing monies. Now, if you've heard my training on modified endowment contracts, you saw that you can't just put in one lump sum and then walk away and never have an ongoing monthly premium or annual premium. The IRS doesn't allow that anymore without it being taxable. So 95% upfront, 50 to 80% of the monthly premium. So a real quick example, if you put in $10,000 up front, then we would want $9,500 of that to be available immediately for your use. If you put in $10,000 a month going forward after that, we would want $5,000 to $8,000 of that to be available immediately for your use. Now you say, well, Scott, what about the 50 to 20% that I'm not getting, right? That's not going directly into my cash? Well, it's a great question. That goes to what's called the cost of insurance, to setting up the account. These accounts are front-end loaded, so all the fees typically come out in the first 12, 24, 36 months that these accounts are paid for. So they become more and more efficient as time passes, okay? So we want this money to immediately show up. Now, keep in mind, just by way of perspective or a comparison, the typical whole life policy out there, you pay into it for 1, 2, 3, sometimes even 4 years before any cash value shows up. So a long period of time. These accounts are not that way. So you have to fight against what's called the arrival syndrome. And Nelson describes that in his book, Becoming Your Own Banker, as the thought, once you hear the word insurance or whole life insurance, you automatically say, oh yeah, I know what that is. I know all about that. And so you shut down the possibility for learning, okay? Don't do that, because unless you've been in a very rare setting where you've been with a lot of high net worth individuals, or an authorized practitioner like myself, where you've seen this particular type of product, you've probably never seen this before. This will probably be your first look at it, right? So the second thing, or number 3 here, so how does that build? So if you know these are the 2 considerations, upfront and then monthly, how much cash of those shows up immediately? Then thirdly, let's see how it's broken down. And this really gets into the construction. So the first part of the construction is the base whole life insurance. That will be about 30% of your premium. Not 30% of the death benefit, but 30% of your premium, okay? So that would generate an example. Now these are just examples, so don't hold me to these specific numbers. I'm just showing you an example. That would give you a face amount or a death benefit of whole life insurance of $255,212. Now you say, Scott, that's an odd amount. Well, it's odd because the death benefit's not most of our clients' primary goal. It's a great attribute, great characteristic, no doubt about it. Life insurance is critically important. It's extremely valuable. We're very proud of that component of what we do, but it's not the main issue. Most of our clients are looking for banking. They want to have money coming in, money going out. They want to be able to acquire things and avoid interest charges and avoid the opportunity cost. So our clients are looking for the cash value component. So it would generate an odd amount because the cash value premium-wise will be an even amount, right? So it's going to generate an odd face amount. Next is additional term life insurance. Why the term insurance? Because we have to add that in to prevent this policy from becoming a MEC, or a modified endowment contract. When it becomes a modified endowment contract, it's taxable. So we have to find a way by adding additional face amount or death benefit to keep that from becoming taxed. Now we do it in term life insurance because term insurance is less expensive than whole life insurance is. And then thirdly, there's a component called paid up additions. This is the secret sauce, if you will. This is what must be present in a privatized banking system for it to work properly. And we want about 65% of all the premium dollars going here. That also has a face amount that'll be attached to it. It'll be a smaller one, but it does have a face amount. So then if you give an example of $10,000 a month in premium, $3,000 would be going to the whole life, $3,000. $500 would be going to the term. That's just 5% of the premium, right? And then $6,500 would be going to the paid up additions. That's instant cash for you, okay? So that's a total of $10,000. So that $10,000 monthly premium is broken up into 3 different components: the base whole life, the term insurance, and the paid up addition. Okay, and I'm simplifying things here for training purposes. But anyway, so what's the goal? Why the base whole life? Why the term? Why the paid up addition? So the purpose of the base whole life, this is where the stability comes from. This is also where the guarantees come from. The base whole life policy drives the guarantees on this product. It's also where the foundation of the entire system lies. So you want a good, strong foundation of that whole life insurance. So that's where we start. Then we build on top of the foundation, the walls, right? That's the term insurance. The term insurance, the purpose of that is to have a low cost of insurance. You get a whole lot of a face amount for not very much in premium. So in this example, $4.1 million for only about $500 a month. And it also has a high death benefit and future conversion options. So you need to look at that term insurance that's part of these plans as your inventory. So you've got all the goods on the shelf, right, that you're going to sell. But then when you start moving stuff off the shelves, you got to do what? Go back to your inventory, bring more out and set it on the shelves, right? Because the last thing you want to have is have a beautiful grocery store with empty shelves. People won't shop there. You've got to maintain full shelves, right? That's just an analogy. What we're saying is you'll have an additional $4.165 million in this example to convert to this whole life. That's the banking policy. The whole life is the only one that builds cash value. Whole life and the paid up additions. Term insurance does not build cash value. So low cost of insurance, high death benefit, and future conversion. So in this example, we can grow the premiums by about 20, maybe 15 to 17 times, because 4.1 million divided by 255,000 would be about 15, 17 times, right? So you could put 15 to 17 times as much in this when the time is right, when you want to do it. And then lastly is the paid up additions. The purpose of paid up additions is immediate cash and long-term accumulation. That's where the cash comes in immediately for your purposes. There's no fees involved when you do a loan. We'll cover loans on a different video, but you can access it anytime. There's no prepayment penalties, no early access penalties, and no structured paybacks. So you can pay them back as you want, when you want, if you want. So this is the IBC, or Privatized Banking Account Construction.